Most people who start investing for the first time have no idea what they are actually buying. They open an app, they see a list of stocks and funds, and they either pick something that sounds familiar or they freeze entirely. Today, we are looking at one of the most widely discussed investment options in personal finance for beginners. It is called an index fund. Understanding what it is, how it works, and why it comes up so frequently in beginner investing discussions is genuinely useful, regardless of what someone ultimately decides to do with their money. Let us break it down. Intro. Welcome to Yield Report Daily, where we break down personal finance in plain English. No jargon, no financial advice, just clear education you can actually use. Everything in this video is for educational purposes only. We are not financial advisors, and nothing here is a recommendation to buy or sell any investment. If you are new here, subscribe because we post a new video every week. Now, index funds, what they are, how they work, and why so many people in the personal finance world discuss them the way they do. Section 1. What is an index fund? An index fund is a type of investment fund that is designed to track the performance of a specific market index. A market index is simply a list of companies that represents a particular segment of the stock market. The most well-known index in the United States is the S&P 500, which tracks the 500 largest publicly traded companies in the country. When you own a share in an S&P 500 index fund, you are essentially owning a tiny slice of all 500 of those companies at once. Rather than picking one company to invest in, you are spreading your money across 500 companies in a single purchase. The fund automatically adjusts its holdings when companies are added to or removed from the index, so you do not need to do anything actively. That is the core idea behind index investing. One fund, broad exposure. No stock picking required. Index funds versus actively managed funds. To understand why index funds come up so often in personal finance discussions, it helps to understand what they are being compared to. The alternative to an index fund is an actively managed fund. An actively managed fund has a team of professional fund managers who research companies, make decisions about what to buy and sell, and try to beat the market. This sounds appealing. Professionals making decisions with deep research sounds like it should outperform a simple fund that just tracks an index. The challenge is that data over long time periods has consistently shown that the majority of actively managed funds underperform their benchmark index after fees are taken into account. The reason fees matter so much is that actively managed funds typically charge significantly higher fees than index funds because you are paying for the research team and management. A small difference in annual fees compounds significantly over decades. An index fund that charges 0.03% per year versus an actively managed fund charging 1% per year might seem like a small difference, but over 30 years that gap in fees alone can represent a meaningful portion of total returns. Section 3. How index funds actually make money. Index funds grow in value in two main ways. The first is capital appreciation. If the companies in the index grow in value over time, the value of the fund goes up. The second is dividends. Many companies in an index pay dividends, which are regular cash payments to shareholders. Index funds collect these dividends and either pay them out to investors or reinvest them automatically back into the fund, depending on the fund structure. It is worth noting that index funds go down in value as well as up. When the stock market falls, the value of an index fund falls with it. This is not a failure of the fund. It is tracking the index accurately. Historically, the major U.S. indices have recovered from downturns and gone on to reach new highs over long time periods. But past performance does not guarantee future results. This is one of the most important points in any discussion of investing. Section 4. ETFs versus mutual funds. Index funds come in two main structures. The first is an ETF, which stands for Exchange Traded Fund. An ETF trades on the stock market, just like an individual stock. You can buy and sell it at any point during market hours, and the price changes throughout the day. The second structure is a mutual fund. A mutual fund is priced once per day after the market closes, and you buy or sell at that end-of-day price. For most beginners using an investing app, they will encounter ETF index funds most frequently. Common examples that come up often in personal finance discussions include VOO, which tracks the S&P 500 and is offered by Vanguard, and VTI, which tracks the total US stock market and is also offered by Vanguard. Fidelity offers similar options with no minimum investment requirement, which makes them widely discussed as accessible starting points for people just beginning to invest. When comparing index funds, one of the most important numbers to look at is the expense ratio. The expense ratio is the annual fee charged by the fund, expressed as a percentage of your investment. For index funds, this is typically very low. Many of the most widely discussed index funds have expense ratios of 0.03 to 0.2% per year. On a $10,000 investment, 0.03% works out to just $3 per year in fees. This is one of the reasons index funds are discussed so frequently as a cost-efficient option compared to actively managed funds, where expense ratios can be 1% or higher. When comparing two funds that track the same index, the expense ratio is often the primary differentiator, since the underlying performance should be nearly identical. Common questions. A few questions come up consistently when people first learn about index funds. The first is whether you need a lot of money to start. Many brokerages discussed in the personal finance community allow you to buy fractional shares of ETFs, meaning you can invest as little as $1 into a fund that tracks the S&P 500. Platforms like Fidelity and Charles Schwab are frequently mentioned in this context. The second question is whether index funds are diversified. Owning an S&P 500 index fund means owning a slice of 500 companies across many different industries. That is significantly more diversification than owning shares in one or two individual companies. The third question is about tax. Index funds held in a regular brokerage account may generate capital gains taxes when sold at a profit, or taxes on dividends received. Index funds held inside a tax-advantaged account, like a Roth IRA or a traditional 401k, may have different tax treatment. Tax rules are complex and vary by individual situation, so this is an area where speaking with a qualified tax professional is commonly discussed as a worthwhile step. Index funds are one of the most discussed investment vehicles in personal finance education, particularly for people who are new to investing and want broad market exposure without the complexity of picking individual stocks. The core appeal that gets discussed is straightforward. Low cost, broad diversification, no active management required. Whether index funds are appropriate for any individual depends on that person's own circumstances, goals, and risk tolerance, which is why every discussion of investing comes back to the same point. Education is the starting point. Personal decisions come after. Links to platforms mentioned in this video are in the description. Subscribe to Yield Report Daily for a new personal finance video every week. And if you missed our earlier video on how to start investing with just $10, that is a great companion to this one. Link on screen now. See you in the next one.